Well, great. We're going to go ahead and begin. So today's class is on price action trading. I want to thank you all for coming. We are recording this webinar. Before we begin, I just want to say welcome to all the new people here. If this is your first time, please let me know. Do see a lot of familiar faces, but it's also I see some new ones in here as well. It's good to have you here. Thank you for coming. And for those of you that are still Jan's first time, Maria's first time, welcome. Dry Desert, good to see you. And Mike, definitely, go ahead and email me after the class, and we'll be happy to talk about it. So, if it is your first time or you're still getting new to this class, I just want you to feel comfortable asking questions at any point in time. So, at any point in time, don't worry about interrupting me or anything like that. At any point in time, if you have questions, please feel free to ask. Don't hesitate. This is a completely open forum. So. Excuse me, I have my tea. Just sipping I bought this nice tea when I was in Hong Kong, this Premium Wuye Lao Mi, and it is a very nice tea. I'm enjoying it a lot. Looking forward to getting back to Hong Kong so I can stock up on some of my premium teas. Email address, info@secondskies.com. Okay, great. So, with that being said, let's go ahead and begin. I want to talk about a couple trades. As you all have been following the format for a little bit, I have been generally doing the format where each week I pick one of my trades from the week, either this week that I've started or last week that we had running, and I talk about the price action that I use to make that trade. Now, I make trades on not just price action. I have other systems as well, but I generally have one, that I like to pick that is just a pure price action trade, and I share that trade with you and go through it step by step, explaining everything prior to it, what I saw in the price action, what things that were queuing me in from a price action perspective, how I traded it from a pure price action perspective, and what my entry stop element was, so that you can get the feel of how I make these trades in real time and see what kind of trades we make, so that you can understand exactly what I went through and then how you can use those techniques as well. So that's the general format of the class. Now I have two of them I'd like to go through today. Maybe we'll get through both of them, maybe we won't. It all depends. We've had some really good lively discussions and questions over the last few weeks, and that always makes it interesting. And the thing about it is, if you have a question, that's a really good thing. That's something that's on your mind. It could be a question about the stuff we're talking about in real time, but you may also have a question about something that's affecting your trading. And with that being said, those are questions that are also welcome here as well. Well, with that being said, I want to move forward onto a trade that I actually wrote about in my ForexStreet.net blog, talked about it, and kind of hinted as to what the setup was. So here is the actual link, which was written just yesterday. So for those of you who don't follow my blog, you're welcome to follow my blog. I write here on a daily basis generally. Maybe take Fridays off. Actually, generally take Fridays off. And I wrote about this trade yesterday on the dollar Swiss. Now, many of you have been following this for a while. I've been pretty bearish on the dollar Swiss for a long period of time. And I've been writing about how, hey, I'm still going to be looking to sell it until I see something that really changes my mind. Remember, as traders, the worst thing you want to be is monogamous to a position, only bearish or only bullish. You have to evolve with the market, and that's not just as the structures of the market change over time, but you also have to evolve with things in real time as they change, because sometimes markets just change direction, and that's part of it. Now, for the longest time, dollar Swiss has been very stable below the 20 EMA. It's offered a lot of pullbacks to the 20 EMA and a lot of opportunities to get back short again. And one of the things that happened most recently was it just kind of got really parabolic, if you can see the nature of the curvature at the end. Take a look at the curvature of the price action. Does everybody see how it's really parabolic towards the end? Yes? Let me know if you can kind of spot that kind of curvature in the price action. But usually when things go parabolic, that's usually or oftentimes can be a sign that the move is ending, or at least on a short-term basis it's ending and it's going to need to bounce. On top of it, we've had last week, towards the very beginning of the week, we had some panic selling in the market, particularly in the global markets. And generally when there is panic selling in the global markets, in the indices, that's usually a time when the market starts to correct and pull back a little bit. And that's partially because the institutions were way aware of this ahead of time. So they have been shorting the markets for a long period of time. By the time it's made it to the general public and everybody is freaking out, that usually creates a situation where people start to realize, okay, this thing has gone way too far. And in those panic selling moments, you usually see some sort of a bounce. And that can be both in currencies and that can be in also indices as well. And so we had this combination of this environment in the global indices where there was this kind of panic selling, and we also had this parabolic nature in the curve. Now there was a couple other things that really cued me off that we might be coming into something. I'm still going to hold my bearish bias, but I'm going to watch, and this is where I was last week. In fact, when we taught the class, which was on the 9th, it was this day and it was selling, and it was just selling. In fact, it was this day. In the very beginning of the class, it was around sub 7,500, and it made it all the way down to a low of 70.70. So it dropped 400 pips after we had taught this class. That was a tremendous amount of losses. But there were three other things that really cued me off that said, wait a minute, something really strange is happening here, and beware. The first one was the nature of how this candle closed. Take a look at this candle. What I'm going to do is I'm going to zoom out to a daily time frame. Keep in mind, dollar Swiss has been bearish for quite a long time now. As you can see, it's been bearish since almost like 118. Now, if we look at this year alone, take a look at this candle, and then take a look at the rest of the candles. Now, this thing has been selling off 2 out of every 3 days on average. So the selling has been consistent and pervasive. But this one was incredibly unique. Do you see how much larger this candle is in comparison to everything else? Does everybody see that? It's just completely different and unique in comparison to everything else. Can everybody see that? Yes? Okay, great. Now, when you have a parabolic move, that's usually something that warns a trader. It's possible that we're going to see a bounce or a reversal. It could be a full-blown reversal. It could be a retracement. But oftentimes when you see a parabolic move, that's usually one of the first cues for a trader that something may be turning around at this point. But then to also see such a large candle at the very end of it oftentimes marks the reversal, or at least the beginning of some sort of retracement. Because the market is so exacerbated at that point, there's so many people involved in that thing, that you really have a hard time finding new sellers at that point. On top of it, the markets have been so volatile on the Swiss franc that the SMB had, they were getting so tired of it. They were getting so tired of it that it was really hurting exporters' business inside Switzerland, and it was really starting to affect their economy. And so you have extreme volatility, something they haven't seen in over a year in one day, plus a parabolic curve. And oftentimes, when a move goes parabolic, the last candle of that parabolic move is the largest candle. It's very often the case if you look at parabolic moves. And that is also another sign that the markets are possibly reversing or going to perform some sort of retracement. And yes, this is on a daily time frame. Now, that and a couple other things had also alerted me, which was I started to look at how far away price action was from the 20 EMA. And I looked at this and I said, wait a minute. This thing is closing right here, at 72.07. The 20 EMA on the daily time frame is at 77.80, 580 pips. When I look back over the entire year, even though this has been selling very consistently, this is the farthest spread I had seen between the daily 20 EMA and price action in a very long time. A very long time. In fact, I couldn't even recall if I went even further back, maybe here. Maybe. At this point. Yeah, pretty close. Almost. Still about 80 pips short. But this was the largest spread I had seen from the 20 EMA and price action. And it was really starting to point to me, it really was communicating, hey Chris, I know you like to be bearish, you've been making a lot of money being bearish, but this is looking very extreme. And when things look really extreme is when I get a little bit concerned about continuing along with those things. Usually when things look that extreme is the point where I start to say, you know what, it might be time to kind of pull back on things a little bit. It might be time to just sit back and wait and see. If it really is going to remain short and the trend is going to continue, it should at least pull back to the 20 EMA. Anytime it gets this far away from the 20 EMA, it usually starts to pull its way back towards it. The market has to normalize just a little bit. So here we are, we're at the super extreme levels. We see the largest candle that I've seen in at least over a year, actually 2 years. We have extreme spread between the 20 EMA and the price action. And then on top of it, we have a parabolic move with the largest candle at the end. All of that started to warn me, hey, don't pile on any new shorts. Sit back, take a break, and see what happens over the next few days. And over the next few days, the thing didn't disappoint. After holding serve right over here, I felt like if it really was going to continue short, well then I would either want to get back in on a pullback to 24 or wait for a break of the prior lows. Well, the next day, things started to look very interesting. As we all know the story about the Swiss intervening, the Europe banning short selling, and then also the SMB saying, hey, we are considering pegging this to, we're considering pegging the Swiss franc to the euro. All of a sudden, everybody said, well, wait a minute. That changes the game. That changes the game in the sense of that may mean that they've kind of had enough and they're really seriously going to start using big weapons to get involved in this and curb how this thing has been appreciating against everything across the board. And what happened the next day? It followed up. Prior to this, this was the largest candle we had seen the entire year. But then this one also matches it punch for punch. So we're talking about something that had been an extreme downtrend was met with a counteractive extreme up move. Now, what does that communicate to you? Think about it for a second from an order flow perspective. It should be very communicative to you. So from an order flow perspective, can you all glean what that was really pointing to? A fight back, well, that's a good point. That's close. What else? I want you all to really look at this and kind of think about, hey, what is this impulsive wave? Impulsive waves are much larger structures, so I wouldn't call it an impulsive wave. I would call it an impulsive candle, but waves are much larger structures. Emmanuel says intervention. Okay. Equal reaction. Good. Chima is starting to get there. And Eklova is also starting to get there. Change in fundamentals maybe, but change of hands and sellers to buyers. Okay, so here's some people that are starting to get it. So Michael's saying buyers taking control for now. Yes to that. Eklova pointed out something. Change of hands and sellers and buyers. Yes, an extreme change of hands. Chima pointed out something, an equal reaction. And, okay, great. So those are the key points that we can take out from this. Now, what does that mean? If something has been exerting maximum force into a downtrend, and at the very moment it exerts maximum force in the downtrend, it gets a counter move that is just as strong, if not stronger, than the prior move, then the only way that can happen from an order flow standpoint is an extreme change of hands. It's not just no sellers left to sell. It also means that new players entered the market on the other side of the market. If it was just profit taking, we wouldn't see a V bottom unless it was a mass coordinated profit taking, and that is very, very rare. Or the only other scenario I can possibly think of from an order flow standpoint that would cause a V bottom and such a sharp reaction to the opposite side like this is if there was one major player that held an extremely large position on dollar Swiss, and that person had such a huge portion of the market that they got out in one shot. The chances of that happening in the Forex market are extreme. You can see it in silver, you can see it in gold, you can see it in oil, you can see it on particular commodities, but it's very difficult, if not impossible, for one player to have such a dominant hand in the FX market. It's too much liquidity, it's too deep a liquidity pool for that to happen, and too many players. Therefore, the only reasonable conclusion from an order flow standpoint is that we had an extreme change of hands on the other side of the market. And when I see an extreme change of hands, especially like this, after such an extreme move, it's usually a sign of, whoa, pause, wait, see what's going to happen. That's extreme. That's something that if you were planning on being short, don't take it right away. You need to sit back and see what happens since then. And you may need to consider going long, because it's very rare that the market can be so far short and then all of a sudden switch to so far long. And there we go. Now all of a sudden we're extremely long. It's very rare for order flow to change hands that fast. So with that being said, whatever that counter force was really strong and overpowering to have stopped the downtrend in its tracks and then reverse course so sharply. Does that all make sense from an order flow perspective? Yes? It's very important that when you're trading price action, you're not just trading candles and structures and things like that and just reactive. That's just reactive structural price action. That is trading without understanding. Once you really start to look at the chart and look beyond the chart, past the chart, and understand the price action or the order flow that is behind the price action, that's when you really start to become empowered as a trader. If you look at price action as just patterns to be traded, you're really just a reactionary price action trader. You really don't understand what's going on. You're just kind of following orders because the patterns, seemed like a good thing. But once you really are to understand what kind of order flow is behind those patterns or behind any move, that's when you become a really empowered price action trader. So that's also why I'm not a big fan of, or I'm not the biggest fan of candlesticks, because they don't teach you what the underlying price action is behind that. That takes a little bit of skill, meditation, and reflection to do it, and some experience and understanding of the market. But it's something that can be learned. And that's why I'm also not a fan of just saying, hey, well, I got this pattern, so I'm going to trade it. Well, do you really understand what's behind that? So with that being said, I saw this really extreme move, and I remember something that I learned a long time ago, which is that V bottoms statistically only happen about 10% of the time. And we're talking on daily time frames. 10% of the time, when we've had an established trend, V bottoms only occur about 10% of the time. It's a very rare event. The reason why it's so rare is because when you have such an established trend, there's usually a large amount of players that are involved in that trend. And when that being said, if the market runs into some sort of resistance or reversal or whatever it is, it's very rare that all of those players are going to just all of a sudden dump all their positions and give up. Keep in mind, they've been in control for a long time. They've been they've been in control for a long time, and they've been making money for a long time in this trend, and they've probably taken many pullbacks along the way and made money on that. And so with that being said, very rarely do these people that are already involved in the trend, that have been in the trend for a long time, just all of a sudden give up. And so they usually make a second push to get back in it. Either they put in new orders, or other people come in and put in new orders for them. But very rarely does a trend just make a top and then it never sees that top again. It's very rare. Usually there's a second chance, which is like a double top or double bottom, or a higher low or a higher high, or there's some sort of attempt at that. And so when a V bottom does occur, it's usually very rare, and it's something that you have to pay attention to. So with that being said, these were all the things that were going through my mind after we had bounced. And then after this candle, I just said, well, I need to step back and say, okay, wait. I knew when we were this far away, if I was going to reshort, I wanted to wait to the 20 EMA. Many of you have been in this class for a while, been talking about, hey, during trends, one of the best places to get back into a new trend signal is to wait for a pullback to the 20 EMA. Well, with that being said, that's what was my first thought. Especially after this candle, I was like, okay, if I'm going to get back in short, I want to wait to 20 EMA. But I was very hesitant in the face of this candle. Then the next candle opened up, dipped just a little bit, not much, and then closed right on top of the 20 EMA. Very close to the high. Very rarely do 20 EMA rejections work in such a way that they close right on the 20 EMA, then they're closing towards the highs of that candle, and they're coming off of such an extreme move. So I said, you know what? I don't want to take this reversal right now. I'm suspending my belief and judgment that this trend is going to continue, and I'm going to see what else is out there. So then I said, well, wait a minute. Let's take a look at this for a second. And then I pulled up a fib. And I said, that's interesting. I started to look at these fibs and said, well, let's take a look at this move. Here we are. How do these fibs line up? And I'll get to your questions in just a moment here. So, first fib lined up pretty well. Lined up with a prior support, and the first day's candle, big reaction, had closed just below it. So that's pretty decent. I liked it. The second thing I liked is I liked how this fib had lined up pretty much with the 20 EMA. It had pointed out that, hey, this had pretty good alignment, plus 2 prior rejections over here. And then we have the third fib, the 61.8. And I said, okay, not bad at all. I like this. Yeah, I like the positioning of these fibs. In fact, let me see if hold on one second. There was another chart that I had. My apologies. Let me redraw this for a second. I want to draw it. There we go. Okay. So here we are. First fib lines up with these prior reactions and lines up with the 20 EMA. And I thought, hey, this thing's stopping right here. If it breaks this and the 20 EMA, something it hasn't done for over a month, and holds above it, well, then that generally means that means that the market's now on the other side. And so what happens? The market opens, and it just takes off, and it goes straight for the 8,000. And it was a little too fast for me to get in. And I said, you know what? No problem. No problem. That's fine. Now, this, if you were all paying attention to my blog, yesterday, when I wrote this blog post, the market was right about here. It had rejected off of 8,000. It was sitting right here. Here's the link to the blog post. And I had said, hey, dollar Swiss stuck between 2 levels, 50% Fibonacci over here, and conveniently parked 38.2 along with the 20 EMA. I even hinted inside the blog post, if the market pulls back to the 20 EMA and the Fibonacci, that would be a great entry, especially if you're bullish, to get long, targeting this fib again in these prior highs. So the market was here at the time that I wrote this blog post, as you can see in the candle in the chart. It then dipped way down to here. And when it dipped, my first thought was this could be a very serious rejection. You know, it has climbed for 4 days, and it's climbed 930 pips. Maybe 8,000 is a place where the people that were still bearish on it said, hey, that's enough. Then the market opens, dips right to my 20 EMA and Fibonacci. And if you know how much, if you've been coming to this class, you'll know how much of a 20 EMA aficionado I've been in terms of catching pullbacks on existing moves. Wait till they pull back to 20 EMA and getting in. The combination of this thing climbing 4 candles in a row, 930 pips, on top of a nice 20 EMA Fibonacci combination here, set up a perfect, nice trade setup. Stop just below the lows of this candle, 30 pips below it, and look at my target. 225 pips, and we're talking candle lows, 77.73, so a stop at 77.43, 35 pip stop, and a 230 pip target. It's an 8-to-1 R. What did I say last week? In these volatile environments, there are a lot of different plays, but look for the ones for very high R. The opportunities are there. If you think they're going to come every day, they're not going to come every day. Just be patient for it. But those high R opportunities are out there. So for a lot of you that are always giving me the complaint, oh, well, I can't trade off a daily time frame, the stops are too big. Find me a trade where you were able to, on a 1-hour time frame, get a 35 pip stop and a 230 pip target. A really good opportunity like that. You won't find them that many. You very rarely will. In fact, I'd be willing to bet many of you that are making trades off a 1-hour time frame might have had stops larger than me. So that excuse that you can't find trades that have, small stops on a daily time frame, I just don't buy it. I see these all the time. Every single week I've been pointing out trades, and never have I pointed out a trade that had anything less than a 2, 2.25, 2.5 R. Some of them 4, 5, 6, 7, up to 8-to-1 R. And I've been only showing you trades on 4 hours and daily time frames. So with that being said, can everybody see how this was just a simple price action setup? How all my reasoning ahead of time had pointed to this, clued me into this, and then showed this very nice little setup? Can everybody see that? How I got into it, what I saw ahead of time, and why I decided not to short? As of last Wednesday, I was still considering shorts. But then at the end of this candle, I said that's the end of it. Can everybody see that? Let's get in some questions here. I'm still in the trade, and I'm holding for a target just shy of this here, about 50 pips shy. Okay, so I got to reverse back. So Mike and Murray, yes, please email me. I'll definitely answer your questions right after this. Okay, Michael, good to hear on the T there. Okay, so Philip J., is that possible exhaustion? It could be. It's probably a combination of a lot of things. I don't just think it's one thing. I think it also has to do with the SMB being very serious about it. Please excuse me, I'm making noises. I'm filling up my tea. I brought my thermos with my hot water here so I could refill. So yeah, it's probably a combination of a lot of things. It's rarely ever just one thing. Mike says, takes big money to make that kind of candle. Absolutely. It takes a lot of big money, and it also takes a lot of seriousness. Think about it. Dollar Swiss has been trending since 117 in a consistent downtrend. Since then, it's been selling almost 2 out of every 3 days. So when the thing is at its absolute peak, step in there and say, I'm drawing the line in the sand. This has gone too far, and I'm going to put a lot of money behind it. You have to be very serious to want to do that. So it's not just big money, it's very seriousness about your intention. So Carlos says the long candle on the daily chart, correct. Okay, great. So Echo says definitely good example of a V bottom in all the CHF charts. Is it the SMB participant? More than likely. More than likely they were involved in this. There's no way we can say 100%, but more than likely. So, yes, definitely. Arachiga, good to have you back. When price is too far away from the 20 EMA, X amount of pips, do you trade back against it, or you only wait until it touches it and trade only in the trend direction? This is an excellent question, Arachiga. And so this is not a speculative question. This is something that I've been trading this, this particular method for a long period of time, and I have a vast amount of experience from it. And it really depends on the situation, in the sense of, if there is a price action trigger to reverse it when it's this extreme, there's this extreme of spread between the 20 EMA and the price action. If there is a price action trigger, I will take it. But that price action trigger has to be very unique. Ideally, it's conforming with some sort of level, maybe a fib projection, maybe a key support and resistance. The problem with dollar Swiss is, we're making all-time lows, or we had been up to that point. So we really didn't have much. We had no history to use. We had nothing to work with. So fib projections were available and all these others, but the bottom line is I would have needed a price action trigger. If I get a price action trigger and it conforms with some key levels or some other things, then I will take the trade looking to go back to the 20 EMA. Does everybody remember what I said last week about the markets and price action and the order flow being and volatility being like a rubber band? That if you hold a rubber band in both your hands, if you hold one hand steady, your left hand steady, and your right hand, you pull the other end of the rubber band. If you pull it a little bit and let go, it snaps back a little bit. But if you pull it really far and let go, it snaps back really hard. That's how these trends work. And so with that being said, yes, these things often like to snap back, and one of the more normalized places that they like to snap back to is 20 EMA. And that's why I like to use that 20 EMA as kind of a gauge and a target of where I'd want to go to. So yes, excellent question. Murray says, any signals price action to predict how far this pushback could be? I could speculate, but here's the thing about it. I could give you some answers right now, and then all of a sudden this thing could go for a run for 500 pips in one day. So in some sense, it wouldn't matter anymore, what my original prediction was. And that's why it's important to be paying attention to price action in real time, because the market doesn't just respond to static levels like Fibonacci's and pivots and support and resistance and things like that. The market is also dynamic. I've been saying this for years. And I've also been saying there are really two types of resistance. There is static resistance, which are fibs, key support and resistance levels, pivots. These are all static levels. And then you have dynamic resistances, which are your major EMAs, things like that. Those are your dynamic resistance. So I've been saying this for years now. And so with that being said, it really depends on how the price action revolves in air. Right now, as it stands, I suspect that it's very likely going to return back to here. And then if it can find a good stability above 8,000, then I suspect besides this brief resistance here at 884, I think after that, it's going to cruise on to 82.25. Now, do I think this is necessarily the end of the trend? Not necessarily. I do think there are going to be some people who are still believing that the long-term trend for the Swiss franc is still in play, and they're just waiting for this little pushback, whether it be SMB or a bunch of other things. They're waiting for all this to calm down so they can get back short in it again. And so, with that being said, I've given you some prior levels of where I think it can go. But I'm also watching price action in real time. If the candles start to get weaker and weaker, I will revise those numbers. If they start to expand and get bigger and bigger, I will expand those numbers. You can't just think of market as a static thing. It's a dynamic thing. It's a living, breathing entity. So does that give you some help there, Murray? Oops, my tea has been brewing way too long. Dun, dun, dun. Hopefully it helps. Okay. Let me put this away, and then we'll get to some more questions. Michael says, how significant is a break of the 20 MA? Does congestion or counter trend follow? The significance of the break of the 20 MA is really based on context. If the market's been ranging, a break of it doesn't mean much. But if the market has been extremely strong and away from it and contained by it for such a long period of time, then the market breaking it, closing above it, and then using it as support shows that the market is treating it differently than how they did before. It's saying, hey, guess what? Before, we used to consider this resistance, at these key levels. Or if we got above it, we would break back below it very shortly. This time, we break above it, we make good headway, and this is the farthest it's been above the 20 MA in a long time. And then the next day, we open up, come back right to it, use it as support, and bounce again. We're up 120 pips from this 20 MA. So that communicates that the market is relating to it a little bit differently, which means that it's a more significant break. The longer the pattern is in play, the more significant the break is. So hopefully I answers your question. An excellent question. Okay, Luke says, you said that you have other systems not based on price action. What are they based on? Shadow systems, and they're also based on Ichimoku. I have 3 models for trading the market. Price action systems, shadow systems, and Ichimoku systems. So those are the umbrellas. And within each of those, I have various systems. I have various price action systems. I have various Ichimoku systems. I have various shadow systems. So hopefully answers your question. Okay. Mike says, would 20 SMA work just as well as the EMA? I generally find that it doesn't. And here's why. If I'm, in terms of an EMA context, if I'm using anything less than a 50, I like to use the EMA because I'm gauging a smaller data set to some degree, but yet large enough that I want to kind of dance in both worlds. And I think the 20 MA does a good job of that. It's something that the market on any time frame consistently likes to pull back to, likes to reference, likes to use, likes to gauge for the strength of the trend or reversal. It's constantly being used and played off of from a price action perspective. And I find that the market is much more responsive to the 20 EMA than it is than the SMA. However, once I get to the 50 time frame, I'm going to the SMA because we're using such a large data set. The more recent closes and more recent price action isn't as irrelevant. One candle over 50 is not that much. One candle over 20 has a lot more significance, or the most recent 3 candles have a lot more significance. So hopefully that explains why I use this. Okay, Mike says, where did I put my stop? Again, I put it 30 pips below the low of this candle here. So if we zoom in, oops, I just put another line. Here was the low of this candle. My theory was, hey, if the 20 MA and the fib really is going to hold, then I should be able to put a stop just below that. And I said, well, here's the low of the price action for that day. Keep in mind, this day opened and didn't produce 1 pip lower. So there was buying from the immediate beginning of this candle. So I said, let's put my stop 30 pips below that. And there it was. Hopefully answers your question. Great question. Okay, scrolling down. Jan, do you take several positions and close one by one when several targets are hit? This is a very good question. I generally like to do it to where I take one position, but I make it large enough so that I can take profits along the way. So let's say I trade 15 standard lots on a position like this. And my real intention is that I'm going to get, let's say, a final target of 82.25. Let's just say that's my final intention. Well, on the 15 lots, what I generally like to do is say, okay, what other targets do I have on the way? Do I have 1 or 2 more targets? Do I have 1, 2, or 3 targets? If I have 3 targets, then I usually like to do it either 1/3, 1/3, and 1/3 per target, or 2/3 on the first target, which is my largest chunk of the position, take that off the board, neutralize as much risk as possible, and then leave the smaller portion for if it goes for a run to my final target. And those final 2 targets, I split the remaining portion in half. In this case, I only have 2 targets. My first target is just 10 pips shy of this one here. However, I am considering, since I already am, if you remember from last week, somebody asked me the question, hey, how many pips do you have to be up before you consider taking some profit neutralizing risk? And the answer was right around 70, 80, 90. Well, right now I'm up about 113, roughly. So with that being said, if it were to close here right now, I would probably take half off the board. It depends on where it closes for the day. But usually when I'm at that point, and I've been in the position for, 8 hours or 12 hours, and I'm up a certain amount, I usually like to at least take some off the board and neutralize some of the risk at that point. Once I get up 70, 80, 90 points or pips, it's usually, hey, I'm going to take something off the board and neutralize the risk. There's no reason why I should be losing money at that point. Unless my target is, 1,000 pips, then it's not worth it to me. So with that being said, in this case, I have two targets. 10 pips shy of this high and just a little bit shy of that. Those are my two targets. So hopefully that answers your question there. Okay. Let me know if I did answer your question, Jan. Okay, great. Ekova says, yesterday on DailyFX, Jamie Sadel posted that he was short on Aussie dollar and his stop was 104.50 and his target was 97.90. But price action, even in the 4 hour, was not supporting that. I took along just below that. How can someone predict that, or how good a trader he is, or is it just a confusion creator? Can you give your remarks? I can only give little remarks on it, or some remarks on it, because I know very little of Jamie Sadel's trading strategy. From what I understand, he's a wave trader, and he trades, waves and Fibonacci's and things like that. And waves and Fibonacci's attempt to be predictive. But when you really start to look at how they derive their trades, it is incredibly subjective. Incredibly subjective. In fact, if you were to put 100 wave traders in the same room, make them look at the same chart, force them to not, they can't talk to either person, they can't look at the other person's analysis or anything like that. Out of the 100 people, maybe 15 of them would have conforming analysis, which to me points to the highly subjective nature of wave trading. And I think the other problem with it is that there's so many moving parts. There's so many moving parts. Even what they call an A wave or a B wave or a C wave has lots of candles in it. And so because of the lack of objectivity and the lack of precision, I'm generally not a big fan of it. Pretty much all of my systems are rule-based, save for these few 20 EMA pullbacks and things like that. Even then, I still have underlying rules, and I still have various parameters and things like that. But, for the most part, the majority of our systems, especially on our course, are all rule-based. So I tend to prefer those because when you have so many subjective moving parts, it's very hard to identify the underlying variables that are the causes of your success. And so if I am correct that Jamie is still using those types of systems, well, they tend to be they tend to attempt to be predictive. But, I can get a wave analyst to say, hey, we're in this, and this correction, or whatever, and then the market starts going the opposite direction, then say, oh, well, I guess it wasn't this, but it's got to be this now. It's got to be, oh, we're in a B wave this, and that, or a 5 wave this, and they constantly allow so much room for things to be changed that to me it's not much of a trading system per se. It's not super objective. So that's all I can really comment on that. And that's my thoughts on that. In terms of how good a trader he is, as far as I can tell, he's not managing large amounts of capital and he doesn't have an audited report. So anytime somebody isn't managing at least decent chunks of capital and does not have an audited trading record, that's usually a sign of concern for me. If they have a fund and their fund is audited, then they got something there. There's something to really stand by their trading. But if they don't have that, then I'm usually a little cautious. I would never invest in anybody's fund unless I'm going to see their audited traders. And so that's all I know about that. Other than that, I can't really say how good a trader he is, because I haven't really spent too much time paying attention to his trading. So hopefully that helps. Ari Chigo says, why 20 EMA instead of 21, which is a fib number? Is it about, it's about the same, isn't it? It is. It's a question of style and preference. You know, normally, almost under any other circumstances, I would have chosen the 21 because I'm a big fan of variables of 3s, 6s, and 9s. And 21 is, you know, has 7 factor of 3 in there. So it would have been more natural for me to do that, but it was one of those things that I just saw how reactive, you know, over years and years and years and years and years, I've seen how reactive the market is to the 20 EMA. And so with that being said, you know, I ended up sticking with that. You know, maybe I would use the 20 EMA, but I just haven't seen that much of an edge. I haven't really seen, you know, any real edge that shows me that 21 is that much better. So hopefully that's your question. John says, is it also good for gold and silver, the 20 EMA? Yes, although I find it to be much more efficient on silver than I do gold. So hopefully that answers your question. I find it to be much more effective on gold than silver, or silver than gold. Gold, I generally, when I'm looking at gold, I generally like to look at larger time frames on gold. So hopefully that answers your question. PLIU says, is this recorded? Yes, it is. Jen says, I like to incorporate Elliott Wave in my strategy just as an extra. And yes, it is an art. Exactly. You know, and again, I'm not saying that Elliott Wave is bad. It's just that the way I prefer to trade is more rule-based. And if I had a scale, and on the right side of the scale is objectivity and the left side of the scale is subjectivity, I'm way more on the right side than I am on the left side. And it's really a question of style and preference. You know, I do know some traders that are wave traders that are really good traders, but I know a lot of traders who are really good traders that are more on the objectivity scale than they are on the subjectivity scale. But the real question is it working for you? If it's working for you, then stay with it. You know, no doubt about it. You know, what is best for you may not be best for me and vice versa. But if you find that rule-based systems tend to work better than non-rule-based systems, then that is, you know, that's my thoughts on that. So hopefully answers your question. Okay, last few questions, and then we got to wrap it up here. Let's see, okay, Solomon says, do you prefer to work with one time frame or more? I generally work with 2 time frames when I'm trading, the 4-hour and daily time frame. And so I do have some systems on smaller time frames for sure, but I generally spend the majority of my time trading off those time frames. And we just pulled up some numbers, and for the last 15 trades, we are 11 for 15 in profitability. And you know, that, I think that just points to the accuracy and consistency. You know, our numbers are generally consistent month after month, year after year after year. And I think a part of that is because of not just the systems, but also the time frames we're trading on. So hopefully answers your question. Manoj says, when dollar Swiss bottomed out, another Swiss pair Aussie Swiss was at a key reversal ledger. Would you include such confluence in your analysis? Not really. It's more of like, hey, not a surprise. Usually when major market reversals happen or major interventions happen, they're not just a random level. It's usually, you know, especially if the SMB didn't get involved, it's usually one of those situations where they are looking for key levels across the board. You know, they look at all the Swiss franc pairs and say, hey, you know, we're all, you know, approaching or at critical levels. Euro Swiss getting there, this Swiss getting there, now is the time to get in. Again, major interventions usually occur at key levels. You know, if you think they're not aware of charts, that would be silly. They're very aware of charts and prices and where things have been historically. So, in fact, if you look at the history of interventions, if you look at across Japan, Switzerland, New Zealand, Australia, they all are very aware of those key levels, and they generally are occurring at key levels. So not surprising to me at all. Not surprising at all. It's more of a question of not so much a confluence, it's more of like, hey, no surprise. You know, it just adds that much more power to the reversal. And last 2 questions, and then we're going to wrap it up. Mike says, can you review appropriate time frames for newbies? What chart should we be looking at? It's an excellent question. I generally recommend starting with the 4-hour and daily time frames because in the very beginning, it's more important that you learn how to be consistent. Inconsistency communicates that something's going wrong. Consistency generally communicates that something's going right. It's the same in golf, it's the same in archery that I'm shooting right now and I'm studying, and it's the same in trading. Consistency usually communicates something that you're doing is right. And you're really starting to zero in on it. And I find that traders, particularly newer traders, are in a little more precarious situation, and so it's best to put them in an environment where they can handle the targets that they're looking at and handle the trading that they're doing, and I find that that's easier on the 4-hour and daily time frames. Just like in archery, when I started over a year ago, they didn't put me on an 18-meter target. You know, they put me on first a 3-meter, and then a 6-meter, and then eventually a 12-meter, and they started working me up to that, you know, those more difficult targets as my skill increased. But overall, in the beginning, for newer traders, I generally recommend the 4-hour and daily time frames. Last question by Murray here. Do you ever use the 80 EMA? No. Negative. Seems to fit a lot of support resistance points. I don't. I can usually spot them on the chart. And so hopefully answers your question. Okay, great. I have to get going. So with that being said, real quick, I just wanted to share with you an article I wrote about trading. Trading lessons from the world's greatest trader, Jesse Livermore. It's on forexstreet.net. Please go ahead and read it. It's for those of you looking for some interesting lessons about one of the most amazing traders of all times, this is a great article out, so feel free to check it out. Have any questions about our services, our courses, check us out, secondsguysforex.com. And any questions specific, email me directly, info@secondsguys.com. Until then, please stay on for our next speaker. I bid you all adieu. Good luck trading, and I'll see you guys next week. Take care, everyone.